So now we are on to the annual report 2014-15. We would first run through the financials once and then we would start reading at other qualitative data. These are the contents we are looking at. Standalone financials 106, consolidated 161. What is the difference between the two? Inclusive of subsidiaries, all the joint ventures. So we'll have a look at consolidated financials first. Auditor's report. Now, there are certain sections that I want you to read when you go back home. Now, generally, the auditor's report would be more or less same with every company which has got good corporate governance, right? Because you would not expect these category of companies to have significant qualifications. But just when you go back home, read through this part carefully. Write down for this week, read auditor's report once. Read through it carefully, even though now subsequent when you prepare financial model, you don't have to read through every part of annual report because 90% of the part is common in every annual report. But just read through it once. Nothing fancy in the annual audit report. So I'm moving on. Consolidated balance sheet. Rupees in crores. Share capital 95.92. Reserves in surplus 4646 and 3943. How is this share capital calculated? Which is a part of the equity. How is this share capital calculated? Number of outstanding shares multiplied with face value of the share. So when you see this 95 crores here, since the face value is 1, we know that now there are 95.92 number of shares outstanding in the market. Are you following this? And let's say if the face value was 1 and if the shares are issued at a price of 50, then that excess 49 is called as securities premium, and securities premium is a part of reserves in surplus. Okay, so reserves are 4646. Last year reserves were 3943. So which means that the difference by which the reserves have increased, that must have been the retained earnings of this year. Profits minus retained earnings are profits minus dividends. Are you following this? Profits minus dividend would accrue to your reserves in the balance sheet. So there are notes 2 and 3 to read more about them in depth. So I'm going to read those notes now. So note 2, authorized 99.5. Then there are 50,000 redeemable cumulative preference shares 0.5. That's how we have a total of 100. Issued, subscribed and paid up is 95.92, and that's how we have the total amount here, face value of rupees 1 each. Are you following this? Now this authorized is the amount on which company has paid stamp duty. Okay, but the number of shares that they've issued is 95.92. At any point of time, company cannot issue shares which is more than authorized capital. And what we can see here is we have almost reached that limit. Right? So in the next few years, we can expect that company might increase its authorized capital by a few crores so that if required, they can issue more shares. Especially you would want to issue shares every year if you're offering ESOPs to your employees. Are you following this? Then reconciliation of number of shares outstanding at the beginning and end of the year. There isn't any difference. Nothing is issued in this year. Then details of shareholder holding more than 5% equity shares in the parent company. So Smriti Holding and Trading Company, ISIS Holding and Trading Company, Gitanjali and Life Insurance Corporation of India. Percentage holding is about 555 and 4.88%. Last year LIC was 6.41%. Is it fine? These companies are holding shares of Asian Paints and their holding is more than 5% of the total shareholding. Now, we'll have to find out who are these. These are just the name of the company, but who's the investor behind these names? So maybe you can find out. Write down this. Find out who are the investors behind Smriti Holding, ISIS Holding, That's a fancy name. And Gitanjali Trading and Investment Private Limited. This is your weekly task. Please make sure that you finish whatever we decide in that week itself. Are we good to go? Okay. This is note 3, reserves and surplus. Total reserve last year 3943. This year 4646. So there are capital reserve, capital redemption reserve, general reserve, foreign currency translation reserve, surplus in statement of profit and loss, amount available for appropriation, and then they've paid dividend, and this is how the amount which is accrued transfer to general reserve, and then we have closing balance of 4646. Are we fine here? Let's go back to balance sheet again. Then there is a minority interest of 263 crores. What is minority interest? See how it works is, this is a consolidated financial statement. Okay, so imagine this is Asian Paints, and Asian Paints have acquired, let us say, a 50% stake or 60% stake in a smaller company. So in a consolidated financial statement, all the assets of subsidiary are added to the assets of parent company. All the liabilities of subsidiary are added to the liabilities of parent company. So essentially what we say is that this small company now is a part of Asian Paints itself, and those 40% shareholder which are minority interest, now those are in a way indirect shareholders of Asian Paints. Are you following this? And therefore this section is typically shown as a part of equity here at the bottom. So these are those shareholders which have shares in the subsidiary company of Asian Paints. Are you fine with this? Non-current liability. So total equity is roughly 4742. Non-current liability is about 389, out of which long-term borrowing is 78 crores, deferred tax liability 180, other long-term liability 11, provisioning 119, which means it appears to be an almost a debt-free company. Isn't it? A really small amount of debt on the balance sheet compared to size of equity. Current liability, short-term borrowing, trade payables is 1548, other current liability 997, short-term provisioning 639. So total of the liability side is about 8,900 crore. Any questions you want to ask here? Will that minority, do we add or do we subtract from where? This you can write down in your notes. I think it will be helpful for all of you. How the treatment is given for minority interest. I'm going to create a very simplified example. Let us say this is parent company A and target company T. I'm creating small balance sheet for both of them. So company A, let us say, has plant of 500. It has got land of 1000 and it has got cash of 1000. It does not have any loan, but it has got only equity of 2500. So 2500 here, 2500 here. Now target company. Target company has, let us say, only plant of 500. Let's say they have cash of 300. They have a bank loan of 300, which gives them an equity of 500. Balance sheet total 800 and 800. Okay, so this is a current scenario without an acquisition. Now company A has decided to acquire, let us say, 70% stake in company T at a price of 350. company A has acquired 70% stake in company T at a price of 350. So now what we would do is we would prepare a consolidated financial statement. Okay, so now this is consolidated balance sheet. So now what we would say is plant of the consolidated entity is 500 plus 500. What? Company A purchased 70% shares of company T by paying a price of 350. So now T has become a subsidiary of A because we've acquired more than 50%. So now we are preparing a consolidated balance sheet of both. Plant 500 of your own, 500 of subsidiary. We would add up the whole of them. So now your plant is 1000. Are you following this? Then land, subsidiary doesn't have any, so we will say 1000. Cash, now see what happens in cash is, your original cash was 1000, then your subsidiary's cash is 300, but you paid 350 towards acquisition to the shareholders of company T. So your cash now would become 950. Total of the balance sheet would be 2950. Equity does not change. Equity remains 2500 as it is. Then bank loan will come in. Bank loan is how much? Because the number of shares you've issued are not changing. Your reserves are not changing. So equity will remain 2500 as it is. But what percentage we do not own in the subsidiary? 30%. So we will call that as minority interest. And 30% is roughly how much? 150. And then you will take, this was 3000. Sorry, this was 300. So now you take a total and it would again be 2950. So minority interest is that part of your subsidiary company which you do not own. And in a way, indirectly, now you're saying that those 30% people, 30% shareholders are my shareholders because they have invested in my subsidiary company and therefore they're shown as a part of your equity. So we have all the borrowing numbers. There are notes available. We would read them when we go on to the balance sheet forecasting part. Then current liability, again there are notes available. See what we would be doing essentially with these numbers. These 5 years of annual report, we would be converting them into an Excel file. And then we would format them based on the format which is easier for us as an analyst to forecast them. Then we will start forecasting. So for example, to forecast what would be the trade payables in 2016, we will have to prepare a schedule called working capital schedule. To forecast what would be long-term borrowing in 2016 onwards, we will have to prepare a debt schedule. For each of the item, we will prepare a schedule and then we will start forecasting those numbers. Are we okay? Then on the asset side, fixed assets, tangible about 2290, intangible 124, capital work in progress 196, goodwill on consolidation about 385, deferred taxes, long-term loans and advances, other non-current assets, and then current investment, inventory, that's a large amount compared to balance sheet, inventory of 2200 crores with a 9000 balance sheet, cash in bank, short-term loans and advances, and other current assets. Any questions you want to ask on this? Anything on the balance sheet which you feel you don't understand? Short-term loans given. Short-term loans taken are liabilities and loans and advances given are assets. Deferred tax assets are how much? 0.20 and liabilities are roughly 180. So deferred tax liability means maybe making use of certain government schemes. They must have been delaying the payment of income taxes. Yes, anything else? Should we go ahead then? Let's look at the income statement now. Consolidated statement of profit and loss, income. 15,473 crores less excise and then net revenue. Right, so we read that section that GST will come in, but then GST will not have a significant impact on difference of these two numbers. So we can always calculate that as percentage, isn't it? Are you following what's happening here? Then other operating revenue, other income, explanation is available for each of these items in the notes, but roughly your total revenue is about 14,000 crores. One thing we can immediately calculate from this, we can calculate a fixed asset turnover ratio. Do that. 14,352 as a ratio to, let's do it only for, okay, let's do it for the whole assets, 2610. 5.49. So roughly compared to the size of the assets company has, revenue is about 5.5 times. Are you following this? So again, now we have a capex estimate, and we'll have to forecast what would be the amount of capex. And again, there has to be a very strong linkage between how your capex is growing and how your revenue is growing. Does it make sense to you? Because if the size of assets on the balance sheet increase, then roughly whatever is the size of assets, about 5.5 times would be the size of revenue. Right? So how it typically works in a modeling world is, we first forecast revenue. That means using revenue drivers, we will forecast what would be the revenue in 2016, 17, 18. Then we will forecast what would be the asset turnover ratios for these years, based on what were the asset turnover ratios in the last year. Then based on that, we will forecast what would be the requirement of capex. And then based on that, we will forecast what would be the requirement of PPE. And based on that, we will forecast what would be the requirement of capex. Are you not following this? See, it's like, let's say your current revenue is 500 and your current assets are 100. So there is an asset turnover ratio of 5. So first we will forecast what would be the asset turnover ratio for next year. Let us assume hypothetically it is going to be 5. Then using the revenue drivers, we will forecast what would be the revenue of next year. Let us say it is 600. So to keep the ratio of 5, we should have total assets of 120, which means your capex in this year would be 20 plus depreciation. Because 100, by the end of the year, it would become 100 minus depreciation. Right? So we want to increase it by 20 plus we want to replenish the depreciation. Following this? Okay. Then expenses, cost of material consumed, purchases of stock in trade, changes in inventory of finished goods, work in progress and stock in trade. The typical strategy is that you can add up these three values and this will typically give you the cost of raw material. Cost of material consumed, purchase of stock in trade, changes in inventory and finished goods. So total of these three numbers. Then employee benefit expense, 907. Let's calculate what percentage it is. 907 as a ratio to 14352. 6%. So again, this is for us, it's a cost driver. Typically, employee benefit expense would always be as a ratio of net revenue. Okay, so if you would calculate this for multiple years, you would realize that generally most of the companies will have a trend. They will spend X percentage of the size of revenue. That will help us forecast what should be employee expense next year. Are we okay? Other expenses. See, one of the exciting things for me with Asian Paints, they are considered as one of the smartest companies in India as far as advertisement and marketing is concerned. So I was very curious to understand what is the efficiency of their marketing expenditure. And typically marketing expenditure is a part of other expenses in the income statement. So we can look at note 24 just to get a sense of how much it is. This is note 12. Note 27, 26, 24. So all these are other expenses. Corporate social responsibilities. Do you see advertisement and sales promotions here? That's about 743. So 743 as a ratio to 14,000. That's how much? 2%. No, it would be 5%. Is it about 5%? So roughly the marketing expenditure or advertisement expenditure is 5% of total revenue. And it would be exciting to compare this ratio with the peers. That means whatever peers operating in the segment, it would be exciting to compare what is their marketing spend as a ratio to total revenue. Is that clear to you? Plus also because of the fact that Asian Paints is focusing more on the retail business, they are expected to have a higher marketing spend compared to other businesses which are focusing more on the industrial areas. Okay, so back to income statement. So this would get us earning before interest, tax, depreciation and amortization. This number is nothing but EBITDA, isn't it? So let's calculate their cash operating profit margin. 2405 as a ratio to 14352. 2405 as a ratio to 14352. 16.75%. Then depreciation, then interest. Now this is your profit before tax. Exceptional items, profit before tax, taxation items, and then the net profit, which is 1395. Can we have the net profit margin? I think about 9%. 1395 to 14352. 9.71. So almost 10%. And then earning per share of 14.54. Earning per share, basic and diluted are same numbers. That means if EPS for basic and diluted is same, it appears that the company has simple capital structure. They do not have ESOPs or other convertible instruments. Is that fine? So how it works is, the question is asked, what is this minority interest? So this is your subsidiary. This is the acquirer's standalone income statement. Okay, let us say sales are 1000, cost are 500 and profit are 500. I'm just ignoring taxes and other items. Let us say this is subsidiary's standalone income statement. Sales 500, cost 300, profit 200. Now when you prepare a consolidated income statement, what you do is, you say consolidated sales is 1500, consolidated cost is 800. So that would give you profit before minority interest of 700. Let's say you have a stake of 70%. So then you would say minus minority interest, which would be 60, and then profit after tax, which would get you as, how much is that? 640. Followed by that we own 70% in that subsidiary. We do not own that remaining 30%. So the subsidiary's share in the subsidiary's minority shareholder share in the subsidiary's profit, that is reduced on consolidated income statement. Make sense now? Sorry? Yes. See, we added. Imagine how would you do it otherwise? Your own profit is 500. Correct? Your own profit is 500. And you own 70% of the subsidiary. 70% of 200 is how much? 140. How much is that? 640. But instead of doing it, what you did is, you said consolidated sales 1500, consolidated cost 800, consolidated profit 700. But out of that profit, minority shareholders can take away 60. They cannot take away, but it belongs to them. 60 belongs to minority shareholder. Therefore, your profit is 640. And this 60 would be added to the minority interest on the balance sheet. The way we add profit to the reserves, in the same fashion, this profit of minority interest is added to the minority interest on the balance sheet section. Is it fine? Okay. Then the cash flow statement. Let's look at, let's build an intuition on what is roughly the total cash the company has and how the cash is coming to them. So cash flow from operations this year, 1187. Then cash flow from investing activity, it is negative 477. And cash flow from financing activity, negative 574. This is typically a sign of a mature company. Of course, we just have 1 year data, but this is how typically mature companies will behave. They will have large inflows on operations. Some part of that inflow would be used for investing purpose. So that's why it's a negative number. And some part of that inflow is used for repaying debt and repaying or paying dividends. And we've seen that their dividend payout ratio is almost 50%. So this CFF must be on account of repayment of or payment of dividends. Are we okay? Fine, that's it. Any questions you want to ask? Anything that's not clear? Yeah, their revenues are growing. We said growth company because markets have valued them substantially higher. Markets are valuing them. See, question is asked is, I said based on cash flows, it looks like a mature company. And previously I made a statement that markets are treating them like a growth stock. The reason why markets are treating them as a growth stock, even after having paid 50% of profits in the form of dividend, company is still able to grow turnover at the rate of 15%. And that's typically the case with most of the consumption related stocks in India, isn't it? You would find a lot of FMCG companies growing at the rate of 10-12% in India. Plus the fact that markets are willing to pay a substantially higher multiple than the industry average, we can say that markets are treating them like a growth stock. But the cash flows, a lot of mature companies will have large amount of cash inflows, and then those inflows would be invested. So CFI negative, CFF negative. A growth company will typically have, so if you would observe the cash flows of growth companies, you would see that CFF would be a negative number. Sorry, my mistake. CFF would be a positive number, meaning of which is they are taking more money from the market. Then they will have a large amount of negative number in CFI, which means they are raising money from the market, they are investing that into business operations, and they might have small amount of positive operations. Okay, whereas generally mature companies will typically have large amount of inflows. They will use that money for investment. So CFI would be negative, but not necessarily as large as growth companies. And then what are we left with? Yes, they would either pay dividend or they would repay the debt. So this number would be large and this number would be not so large. And this number would be large. This would be large. This would be large. This would be small or medium. There is no rule as such, but depending on when you read the cash flow statement, you should be able to build intuition on what company is really thinking right now. And what the theme that we clearly see with Asian Paints is cash flow from operations are being used to pay dividends and they're used to reinvest into business.